I'm Greg Boles, COO of Future Proof Advisors. We help emerging growth and middle market companies, typically between 5 and 50 million in revenue, maximize their sales, profitability, and increase their company's valuations. Okay, let's get into it. Here's 5 reasons why you and your company need to close its books on time. I see it so often where the CEO, entrepreneur, even those in the accounting or finance organization don't make it a priority to close the books as fast as they could or should. And in the end, that creates blind spots for the organization that translate into performance that is less than ideal. So here's 5 reasons why you need to do it. All right, let's get to it. Number 1, good decision-making. As I alluded to just a minute ago, a timely close of the books means that you are assessing all of the known variables and performance of the business, hopefully as recently as just 1 or 2 weeks ago. Armed with that information, the company and its executives can see the key performance indicators and ratios for the business, and that allows for better data-driven decision-making. Okay, number 2, a timely close will allow you to see expense trends by department, profitability by client, or assess how projects are currently trending. You will see and be able to take action much more quickly with a timely close because you have the latest, greatest information, and that will allow you to solve problems, maximize revenue, and cut costs, etc., before too much time passes and you wish you had done it sooner. Okay, number 3, identifying business challenges much more quickly. A timely close means that you will be able to get to these challenges a lot faster. A close that is 3 or 4 weeks into the new month means that all those problems have consistently been happening, and time is money. And if you don't have a timely close, then you are not maximizing the company's performance. Okay, number 4, a timely close will also allow you to see sudden changes in cash flow. Cash is king. Companies run on cash flow. Profits are great, but in the end, cash is what pays the bills, pays the payroll, and ultimately funds profit share, salaries, etc. So a timely close will allow you to see your AR aging and your accounts payable aging, how much your customers owe you, how much your vendors owe you, and you can see very quickly if those cash balances are getting drained and if your accounts receivable is aging out uncollected. That's going to have subtle but very important and perhaps large implications for your cash flow. So a timely close will allow you to nip that in the bud and be able to take action before cash flow is impacted to a large degree. And number 5, and perhaps the most important reason, is for management accountability. When you close the books on time, you are telling the organization and its leadership that business performance is going to be measured, and it's going to be measured timely, and the expectation is that action will be taken on that performance. And so a timely close will allow you to have much quicker budget versus actuals, explanations of expense variances or revenue variances, labor utilization, etc. Your team can be held accountable and, most importantly, armed with the information to make better decisions and to address them before too much time passes. So how fast should you close the books? In general, we would recommend the gold standard be 1 week. Sometimes that might not be possible for the maturity of the company. In that case, 2 weeks is a very good and solid recommendation. We think a close that takes 3 or even 4 weeks is just too late and does not take advantage of better information earlier to maximize your performance. As a recap, here's the 5 reasons. Number 1, good decision-making. Number 2, for department, job, or project level visibility. Number 3, you can pinpoint and identify business challenges much more quickly and be data-driven to address them. Number 4, to see sudden changes in cash flow. And number 5, for management visibility and accountability. I'm Greg Boles with Future Proof Advisors, and we look forward to seeing you in the next video. I hope you enjoyed it. Thanks.